Hey there, this is Trader Tim from over at eMiniMind, and in today's video I wanted to talk about the three types of exits that I use for my trades. This is a technique that can be used on any market, any time frame. I use it for day trading, I use it for my swing trades, but there's really three main exit strategies that I use. And this goes for regardless of even the method or the entry necessarily that you're using to get into a trade. So typically when we get into a trade, we have an initial stop. But then there's also the concept of trail stops, and that is locking in profit as the trade continues in your favor. And there's some different viewpoints on setting up a specific trailing dollar amount. For example, in the E-mini S&P, some people like to just set a trail stop of 2 points, and so as the market continues in your favor, you have this trailing 2-point stop. I don't like to use that method. The approach that I take is a little bit different, and so I wanted to talk about using some examples from the week on the three different methods that I will use. So, two of the methods involve trailing my stop. And then the third method involves a target. And when I'm looking for targets, I'm typically looking for somewhere in the range of 3 to 1 in terms of reward to risk. So if I'm risking 6 ticks on the E-mini S&P, having an expectation that the market could go 18 ticks is not out of the ordinary. 3, 4, 5 points for the E-mini S&P is it's not a small move, but it's by no means an astronomical move that would be considered a home run. So what I use for my trading is a simple 50% retracement using the Fibonacci tool. And so if we go back to Tuesday of this week and we look at the first setup of the morning, it's pretty small. And it's pretty small in that the distance from the 50 to the 61 is barely half a point. And so for my initial exit point, the first of the three methods, is going to be just one tick in front of the negative 23.6% line. So I'm using the 50% as my entry and the negative 23 as a target on the trade. Now this particular trade only has about a 2-point profit potential in that distance from the 50 to the negative 23. But you'll notice that the trade went right to the 23 before reversing. So we can't expect every single trade to be a home run or a big runner. So if you're trading multiple contracts, you can do a number of different exit strategies using the negative 23 with one contract, meaning setting a target, is a good way to get in the habit of hitting singles and doubles. And in conjunction with setting a target, I also like to use a trail stop method at the same time. And so while my initial stop will go out at -6, I will leave that stop alone until we break down of the most recent swing low, or for a long, the most recent swing high. And again, this works for swing trading daily candles. This example happens to be an intraday scenario. And so, leaving my stop alone at -6, once the market starts to sell off, breaking below the swing low on Tuesday, then I will begin to trail each candle's high as the market moves in my favor. And I just have a simple candlestick with the Fibonacci candlestick chart on top of it. So just a slight variation of the traditional candlestick chart. And just by placing my stop one tick above highs of the first candle that breaks down below the swing low, that allows me to tighten my stop as we head towards the target. And in this case, a pretty small trade, not quite that 3-to-1 that I was just talking about. But we traded to the target and we reversed, about trading in beyond the target only about a couple of ticks before reversing. If I pull back to a trade example from Monday, where we have a little bit bigger breakdown. Monday, about hour or so into the morning, we broke the previous swing low, and so drawing from highs down to lows, we had a textbook setup that came up to the 50, entering one tick in front of the 50 to make sure we get that order filled. And so again, we have a negative 23% target down below us. So if you're trading one contract, you can use your initial -6, have that stop, have that target down at just one tick in front of the negative 23, and this will help, again, kind of get in that habit of locking in singles and doubles versus just trying to hit home runs on every single trade. Leave my stop alone at the onset of the trade. Once we break down below the swing low, that lower anchor point that I'm using here, then I'll begin to trail my stop above each candle on the way down. And so if you have one contract, you've got your target down here at the negative 23, market breaks the swing low, and you can start to trail your stop, and as you're trailing, the market gets closer and closer to your target, and then boom, takes you out, locks in that profit. If you've got two contracts, then you can just take off one at the target and continue to trail each candle's high on the way down. And when we get into a situation where we have where the next candle doesn't break the previous candle's low, then I just like to leave my stop alone. Sometimes you'll have a big breakdown candle, and then the market will move sideways for a couple candles and then break down again. So whenever a candle makes a new low, then you can go ahead and drag your stop above the high of that candle and just continue trailing all the way down until you get taken out, market changes direction, and that locks in quite a bit larger profit on the trade. You've got that, if you're just trading two contracts, you've got the first one taken off at the negative 23, and then the second one taken off just by trailing each candle's low, or each candle's high for a short. It would be each candle's low for a long. If we move to another scenario, let's just say, for example, you got long at the open. Not even using a 50% retracement in this case. We'll just stick with Monday since I've got it up here. The third exit trade management trail stop approach that I will use, and this is a little bit more conservative if I want to stay in the trade longer, rather than trailing each candle's low, or perhaps you're trading three contracts, and the first one you take off at plus 18, just an arbitrary target. The second one you trail each candle's low on the way up, and again, double top. I'm just leaving my stop underneath the initial breakout, and then I wait to move it until we break out again. That way, here we have two candles that kind of move sideways, a little bull flag, before continuing on higher again. So trailing each candle's low on the way up until you get taken out. Then the third approach that I like to use, and you could do this with the last contract, the third contract if you're trading 3, or 2, 2, and 2 if you're trading 6, is to trail each swing low on the way up. And so the way that would work, you let the market make a new high, it pulls back, and then it makes another new high, so you can put your stop underneath the swing low. Once the market pulls back, makes a new high again, then you can move your stop from one tick below the previous swing low up underneath the current swing low. Market pulls back, and the key is it needs to make a new high before tightening your stop once again. Market makes a new high, it pulls back, except this time it pulls back and takes you out at that previous swing low. So this approach works very well on daily charts with swing trading. Intraday, if you're getting long at, say, lows of the day, or you're shorting at highs of the day, this can be a much more conservative trail stop method that allows you to stay in the trade for much longer. Trailing each candle would be the more aggressive approach. And so, like I said, you can use a combination of all three. If you're trading multiple contracts, if you're just trading one contract, you could still have an arbitrary target and trail each candle and sort of sandwich, tighten your stop as it gets closer to the target. And then for a little more conservative trail stop, just trailing each swing low or swing high. And the reason that works is because swing lows or swing highs are the areas that develop a trend. And the trend will change at the swing lows and swing highs. And so when we break a swing low, we come down, we make a lower low, then we put in a lower high, and now we have the onset of a new trend, and that's what then getting short at a pullback to a 50% retracement takes us down in a much bigger, stronger move. So a lot more videos on identifying the trends, Fibonacci retracements, Heikin-Ashi charts. You can check those out over at emoneymind.com/trading videos. Trading-videos. And you can check those out. And if you have questions, you can always shoot me an email or leave a comment below. My email is tim@emoneymind.com. Thanks, everyone. Have a great weekend.